Good evening, everyone. I am Shikha Pandey from Kirin Advisors. Welcome to the virtual roadshow of Shanti Inorganics Limited. Today, we will provide a brief overview of the company and its innovative business model. Shanti Inorganics Limited is engaged in the business of manufacturing and trading of sulfur based inorganic chemicals. The company has manufacturing facilities at Vatva and Bawla in Ahmedabad. From management team, we have with us Mr. Avnish Manoj Kumar Patel, Joint Managing Director of the company. Good evening and welcome, sir.
Good evening.
We have from the Vibro Financial Services team, Mr. Roshan Vaishnav, Director of the company. Good evening
Good
and
evening.
welcome, sir.
Good evening.
We also have Mr. Jayesh Vitlani, Senior Vice President of the company. Good evening and welcome, sir.
Good evening. Good evening.
We also have Mr. Tushar Ashar, Vice President of the company. Good evening and welcome, sir.
Good evening.
Now we will play a short corporate video of the company.
Shanti Inorganics Limited is engaged in the manufacturing of sulfur-based inorganic chemicals, namely ammonium bisulfite, sodium bisulfite, sodium metabisulfite, and sodium sulfide. As per the CareEdge report, we hold one of the largest domestic production capacities of bisulfites. Our company operates two manufacturing units in Ahmedabad, Gujarat. Our Vatwa unit has an installed capacity of 18,800 metric tons per annum and is operating at over 92% capacity utilization in financial year 2026. While phase 1 of our Bavla unit, commissioned in February 2025, has an installed capacity of 18,000 metric tons per annum. Phase 2 expansion, which shall be part financed through the proceeds of this issue, is currently underway and is expected to be commissioned in the first quarter of financial year 2028 with an installed capacity of 78,544 metric tons per annum, employing seamless engineering and efficient modern manufacturing practices. Our strategically located production units, proximity to raw materials, and long-term supplier relationships support stable and efficient operations. Our company holds key certifications including ISO 9001, 2015, NSF, Kosher, HACCP, and Halal, reinforcing our commitment to quality, safety, and regulatory compliance. Our products are manufactured in food grade and technical grade and are widely used as preservatives, reducing agents, oxygen scavengers, and process intermediates across industries such as food and beverages, oil fields, chemicals, pharmaceuticals, water treatment, agrochemicals, petrochemicals, cosmetics, paints, and polymers. Our company is led by experienced promoters and supported by a team of over 65 skilled and experienced professionals. We operate with established manufacturing processes and strong customer relationships, catering to diverse product applications and export markets. We export across 15 countries, including Eswatini, Malaysia, the United Arab Emirates, Qatar, Nigeria, Russia, Colombia, Turkey, Puerto Rico, Iraq, Vietnam, Azerbaijan, Egypt, Ghana, and Philippines. We serve 90 domestic and international customers, with exports contributing over 42% of our total revenue in fiscal year 2026. Our company has achieved consistent financial performance over the years. During fiscal year 2026, our revenue from operations stood at 7,122.02 lakh rupees and profit after tax reached 1,022.00 lakh rupees, with revenue and profit after tax registering CAGR of 25.99% and 41.35% respectively over fiscal years 2024 to 2026. Till May 31, 2026, our revenue from operations and profit after tax stood at 1,598.27 lakh rupees and 249.96 lakh rupees respectively. Going forward, we intend to pursue growth through manufacturing capacity, expansion and investments in new plant and machinery to enhance productivity, improve operational efficiencies, and optimize costs while strengthening our domestic and international customer base. We also intend to expand our geographic presence with a focus on high-value Western markets and diversify revenue streams through strategic expansion into new end-user industry segments. Through the enhancement of manufacturing operations, Shanti Inorganics Limited is committed to delivering export-oriented high-grade quality products and strengthening its market position in the sulfur-based inorganic chemical industry.
Now I request Avnish sir to give the short brief of the company, then we'll start with the presentation. Over to you, Avnish sir.
Good evening, everyone. Thank you for joining us today. We, as Shanti Inorganics Limited, we are into manufacturing of sulfur-based inorganic chemicals. We will take you through our presentations, and then I'll be happy to answer all your questions.
Okay, sir. Let's now start with the presentation.
We can start the presentation. Shanti Inorganics is engaged in manufacturing of 4 key sulfur-based inorganic chemicals: ammonium bisulfite, sodium bisulfite, sodium metabisulfite, and sodium sulfite. These products are available in food and technical grade specifications. The application of the products are in various industries such as oil fields, pharmaceuticals, food and beverages, pulp and paper, mining, chemicals, etc. As per the carriage report, we are among the largest bisulfite producer in India. We have 2 manufacturing facility located in Ahmedabad, Gujarat. The combined capacity of both the facilities is 36,800 metric tons per annum. We are expanding our capacity to 1,15,000 metric tons in phase 2. We also hold some of the key certificates like ISO 9001, NSF, Halal, Kosher, and HACCP. We serve our products to more than 10 plus different industries in 15 plus countries, and our clients are across the industries are more than 80 plus. Next slide. We have 2 manufacturing facility, Vatwa plant and Bafla plant. Vatwa plant manufactures ammonium bisulfite, sodium bisulfite, and sodium bisulfite. This facility is a batch-wise production facility having installed capacity of 18,800 metric tons per annum. And this facility is almost fully utilized facility for over last 3 years. We have phase 1 in Bafla plant, where we manufacture sodium sulfite with installed capacity of 18,000 metric tons per annum. It's a fully automatic and continuous type production facility, first in India and the largest production capacity of sodium sulfite in India. We are expanding our capacities in phase 2 of ammonium bisulfite, sodium bisulfite, and sodium metabisulfite by adding 78,544 metric tons per annum. So combined installed capacity of all 3 plants will be more than 1,15,000 metric tons per annum. Next slide. So the company was started by my father in 1998. We incorporated this company to private limited in 2010. From 2010 to 2026, we increased our production capacities. We started exporting our products. We added more products into our portfolio. In last 5 years, we have done 5x growth. And with the expansion of phase 2, we will be having a remarkable milestone in our growth journey. Next slide. While India remains a major market for us, export market is also a key growth driver for us. We export to more than 15 plus countries, mainly from Africa region to Middle East Asia, Far East Asia, and in South America region. Next slide. Mr. Manoj Kumar Patel is my father, who is the chairman and managing director of the company. He has 26 years plus experience in sulfur-based manufacturing industry. He mainly looks after the administration, business development, and finance. Whereas I'm as a joint managing director, I look after the expansion of the Baula phase two. I also look after the export business development. Next slide. So this is our current organization structure. It's a well-organized structure. We are also expanding this organization structure with the expansion of our phase two. We are adding some more departments like QA department, QC departments, some more mechanical and electrical departments. We have recently added marketing department in our portfolio. Next slide. So these are two products out of four which we manufacture: ammonium bisulfite and sodium bisulfite. Ammonium bisulfite has two grades, technical grade and food grade, and one more grade which is catalyzed grade. Ammonium bisulfite majorly goes into manufacturing of caramel color. The caramel color which is used to produce various beverages like Coca-Cola, Pepsi, soya sauce, various bakery products, and some of the alcohols. This product also goes into oil fields to remove oxygen. Sodium bisulfite has again two grades, technical and food grade. We supply this product to more than 10 plus different industries, from wastewater treatment to textiles, mining, chemical industry, petrochemical industry. Next slide. So remaining two products are sodium metabisulfite and sodium sulfite. Sodium metabisulfite and sodium sulfite both have again food and technical grades. Sodium metabisulfite goes into various industries like biscuit manufacturing as a food preservative, in RO plants to remove dissolved chlorine, in pharmaceutical industry as a reducing agent, in leather and tanning leather and tanning industry, in rubber industry, in textile industry. Sodium sulfite has two grades. We supply this product to various industries in large power plants where the uh, boiler plants are there to remove dissolved oxygen from the water. In pulp and paper industry as a bleaching agent, in textiles as a bleaching agent. Product also goes into mining and photography, also into TNT blast material production. Next slide. So these are some of the industries where we currently supply our products, from food and beverages to mining, polymers, paints, ceramic industry, pharmaceutical industries, chemical industries. So we are overall diversified customers. Next slide. Next slide. So the market size of four products is more than 1 billion US dollars across the world. Next slide. As I said, we have done 5x growth in last 4 years. In FY24, we have achieved sales of 45 crores. In FY22, we achieved sales of 13 crores. So the journey started in FY22, and in FY26, we achieved sales of 72 crores with PAT of 10.22 crores. In first 2 months of the current year, we have achieved sales of 16 crores with PAT of 2.49 crores. So our EBITDA has remained between 20-21% in last couple of years. Next slide. These are some of our financial performance ratios. Next slide. Our profit and loss statement. Next slide. Next. So our biggest strength is our geographical diversified customers in India and export market. The second biggest strength is our geographical location. We are located in Ahmedabad, Gujarat. Gujarat is a chemical hub of India. We have one of the largest refinery in the world who produces a huge quantity of sulfur. We also have some other manufacturers located in Gujarat who produces large quantity of our raw materials. So we are not dependent on the imports like our competitors based out of India. We also have the second biggest strength is we have a long-standing relationship with our customers, and most importantly is our certificates. We hold about 5 different certificates which enable us to enter into the market where the customer requires stringent quality parameters and the compliances. And the final our strength is our experienced promoters and senior management team. Next slide. So our strategy is very simple. We want to be on the global map uh, in our products, in our industry. Currently, we are on the India map with the installed capacity of 36,800 metric tons, with additional capacity of 78,000 metric ton in phase two. We will be on the global map. We want to focus on the Western markets, which are premium markets. Next slide. So overall, we are a well-established manufacturing company with a large capacity of our products. Expansions are on the way, which will help us to be on the world map in our industry segment. And we also hold some of the certificates, which helps us to serve our products to 10 plus different industries across the globe. Next slide. We are investing about 107 crores in our phase two expansion, from which we are raising funds through equity. We are raising about 47.23 crores through IPO proceedings. We have also secured term loan from the banks of about 34 crores. We have also done some pre-equity, pre-IPO fundraising about 12.42 crores, and remaining amount will be used from our internal accruals. Next slide. Next. Thank you. Now, I'm happy to answer all your questions one by one.
Yes. Thank you, Avnish sir, for the brief introduction and presentation of the company. We'll start with the Q&A session. I request all the participants to post your questions in the comment box. We have a first question from Gokul. He is asking, how would you describe Shanti Inorganics' core business model and the key factors that differentiate it from other sulfur-based inorganic chemical manufacturers?
So, Shanti Inorganics core business model is high quality premium category production of our products. So, we say that we are among the manufacturer in India who are into the premium grade manufacturing, the international quality products, food grade quality products, and the production technology, our sales and services differentiate us from the other sulfur-based inorganic chemical manufacturers.
Thank you, sir. Next question. Next is from Dhruvesh. He is asking, how does the margin profile differ between food grade and technical grade products?
Obviously, the food grade products have higher margins compared to technical grade products, and the difference is about 8 to 10%.
Okay. Next question. Next is from V. Which end user industries currently contribute the most to revenue, and how do you expect mix to evolve over the next 3 to 5 years?
So in FY26, the largest end user industry we contributed our sales to is food and beverage industry. And looking forward to next 3 to 5 years, this industry, food and beverage, along will remain highest contributed industry in our sales.
Okay. Next question. Next is from Harshal Jha. How sticky are customer relationships in this industry, and what are the typical qualification, approval, and switching requirements for a customer to change suppliers?
So it depends on the industry type. We serve to more than 10 plus industries, but the commonly the customers who are on board with us, we get the monthly orders from them since the products are being consumed on a day-to-day basis. Uh, the typical qualification is your product quality, your plant infrastructure, your production technology, uh, your certificates are key, very important. So switching the requirements of a customer to change the suppliers is quite difficult for them because switching another supplier will it takes a lot of time to develop a new vendor, new supply.
Thank you. Next question. Next is from Kavita. Does the company primarily compete on price, product quality, consistency, certifications, customization, or delivery reliability?
Yes, for the three products, we produce food and technical grade both. One product we are not manufacturing food grade as of now. With the new expansion, we will be producing that food grade quality also in that product also. So currently, we are competing on price with the global manufacturers and domestic manufacturers. Our product quality is internationally approved. We supply to more than 15 plus countries in 10 plus different industries, and the quality and is consistent, approved by our buyers.
Okay. Next question. Next is from Prajwal. He is asking, what are the key barriers to entry in the bisulfites market, particularly for a new manufacturer seeking to serve food, pharmaceutical, and export customers?
So the key barrier is production technology, the quality of your product, and the volumes, consistency in the volumes of your products.
Okay. Next question. Next is from Pradnesh. The Vatwa facility operated at 92.60% utilization in financial year 2026. What is the sustainable utilization level before additional capacity or bottlenecking in required?
So Vatva facility is operated at more than 90% capacity for last 3 years. It will remain same for the next 3 to 5 years, and the sustainable utilization level is 90%, as we have already proved this in last 3 to 4 years. So I do not see any bottlenecking required in this.
Okay. Next question. Next is from Rasika. What customer orders or demand visibility support the proposed 78,544 MTPA Phase 1 capacity at Bala?
So we have been working on this expansion for many years. It encouraged us to go for 78,000 metric ton expansion by our existing buyers. Since we are fully utilized facility, we are not able to supply the full quantities required by our existing buyers. And the as you see that we are serving to more than 10 plus industries, but there are another 5 to 8 industries where we are not able to supply our products because of the higher volumes, higher quality grades. So this overall the market research and analysis helped us to go for the this huge expansion in phase 2.
Thank you. Next question. Next is from Rishi. How much of the proposed phase 2 capacity is intended for existing customers versus new customers and new geographies?
So 35 to 40% of the new production will go to existing customers, and balance will go to new geographies like Western region, and more supplies in Far East Asian countries.
Okay. Next question. Next is from Bhaskar Pawar. How will the proposed automation and new machinery affect manpower cost, product consistency, yields, and overall operating margins?
So manpower cost will definitely improve. It will reduce with the continuous production plant, fully automatic production plant, and the volumes. So in now we will be, instead of 18,800 metric tons in one plant or 18,000 in a second plant, we will be producing 78,000 metric tons in a single production facility. It will help us to reduce our manpower cost by a big margin, and the automation will also help us to reduce the number of manpowers in the facility.
Okay. Next question. Next is from Permit Singh. What contingency does the company have if phase 2 faces cost overruns, delays in machinery delivery, or regulatory approvals?
So the project has already started. We have received all the regulatory approvals to start the project. Machineries have already started coming. and we have already added contingency time of about 90 days. Uh, so we do not see any delays in our project execution from now on.
Okay. Next question. Next is from Sandeep Surve. Can existing Vatva production be shifted or optimized across products because of this fungible capacity? And how does management decide the optimal product mix?
So our Vatva plant is a batch-wise production. It's a multi-product production facility, and batch-wise production gives us advantage of production of our products in customization way. So we are not going to reduce any production in our Vatva facility. Rather than reducing, we will be selling those products to the specific customers who requires customized product parameters. While the continuous production will not give you customized productions parameters, it will give you a bulk production in a larger scale with consistent qualities. So the products will remain same, but the segments will be changed.
Understood, sir. Next question. So next is from Sudhir Sharma. Exports contributed 42.57% of financial year 2026 revenue, compared with 53.83% in financial year 2025. What caused the decline in export share despite overall revenue growth?
So export has declined in FY26 compared to FY25, mainly because of the two reasons. One is the commencement of commercial production of sodium sulfite in 2025, last year. We started selling that product into local market. So the revenues grew from 58 crores to 78 crores. But from 58 to 70 crores, the larger portion was sold to domestic market. So overall, the percentage-wise, the export went down to 42%. The second reason is the uh, disturbance in the Middle East region, which has now resumed, and we have resumed our exports to Middle East Asia despite of closure of Strait of Hormuz.
Okay. Next question. Okay. Next is from Amol Prajapati. How does profitability on export sales compare with domestic sales after freight, clearing, forwarding, and foreign exchange costs?
So it depends on our product, but overall we have higher margins in exports compared to domestic market. But a couple of products out of four products, we have higher margins in domestic market. So it depends on the product grade quality. But overall, from our sales, the average profit margins in export is higher compared to domestic.
Okay. Next question. Okay, next is from Naman Kasar. How confident you are sustaining this EBITDA margin?
We are very confident because see, we are already achieving this EBITDA margin about 20%, 21%. Now we are transforming our production facilities. We are entering into continuous type productions, uh, higher quality grade products. We will be exploring more industries, segments of our customers. So overall, continuous production, large volumes will help us to reduce our overall operating expenditures. Then also we are confident that despite of getting more gains, we will definitely achieve this EBITDA margin about 20 of about 20-21%.
Okay. Next question. Next is from Bijal Bakai. What are margin difference between domestic and export markets?
It depends on the product and the region, but the average difference between domestic and export markets is 3 to 5%.
Okay. Next is from Deepak Mehta. Financial year 2026 included 64 domestic and 20 international customers. What is management strategy for expanding the customer base without compromising credit quality?
See, with the new production facility in Baula Phase 1, we are increasing our customers in both the markets, domestic and international. And we have our standard payment terms, which we follow for all the new customers and existing customers. So, for the large customers in exports, we do on LC terms with them. And for the domestic market, we have average cycle of 45, 50 days. And overall export domestic market, we have average cycle of 60, 65 days, which will remain same in with the future growth also.
Okay. Next question from Bijal Bakai. A working capital cycle and how do we manage the same once we have triple X capacity?
So current working capital cycle is about 65 days, and this will remain nearly same with the 3x capacity and revenue growth. So we have
Okay.
already secured working capital from the banks, and we have unutilized working capital also at present.
Okay, sir. Next question from Raghav Datta. What is the typical tenure of relationships between the company's largest customers and are sales governed by long term contracts, annual arrangements, or purchase orders?
So once we onboard our customer, they remain with us for longer time. 4 out of 10 customers are with us for more than 5 years, and currently uh, we are fully utilized production facility, so our customers are fixed. In the new production facility, we are developing new customers and increasing our production utilization. With many large customers in majorly in the food and beverage business, we do have annual agreements with them. Uh, Other than this food and beverage industry, we do not do any annual or half yearly contracts with them because it's a fully utilized capacity. We do not require to book our quantities, but we do business with all our buyers on monthly basis or a quarterly basis.
Okay, sir. Next is from Gajendra. How much of the company's revenue is recurring in nature versus dependent on spot orders or short term demand?
So, see, we do not see any, or we have not faced any short-term demand from the any particular industry in the recent time. Our products are used as process intermediates, so we supply our products to directly to the consumers, and they consume these products on daily basis. We also supply our products to 10 plus different industries, so we are not dependent on a single geography or a single industry or a couple of industries, so that our business becomes a seasonal business. So there is no short-term demands or spot orders. We get orders on a monthly or quarterly basis from our customers. Many of the customers ask us for these 6 months or 12 months quantity agreement. We do that with them, but we do not fix the prices with them.
Okay.
So revenues
Next.
are increasing. Yes, so revenues are
Okay.
increasing with the expansion of the capacities.
Okay, got it. Thank you, sir. Next question. Next is from Sanjay Patil. Are there plans to enter additional application industries or introduce higher value grades within the existing product portfolio?
Yes, as I said, we produce food grade quality products, but only 3 products out of 4. We do not produce food grade quality in one of the product. which we will be producing with our expansion of phase two. So we will be exploring more industries where the food grade application of our product is there, more the higher volumes, particularly in minings and some other industries where our products are used in huge volumes on a monthly basis. At present, we are unable to supply them in such a large volumes, but with the expansions of phase two, we will be exploring those markets also.
Okay. Next question. Next is from Apeksha. How does the company intend to leverage certifications such as ISO, NSF, kosher, HACCP, and halal to deepen penetration in regulated or premium markets?
So see, these certificates are for the different industries. For the pharmaceutical industry, we require HACCP. For the drinking water industry, we require NSF certificate. So these certificates are just not certificates. We have to implement their SOPs. We have to follow their SOPs. The customers conducts audits on a yearly basis. Some food and beverage customers conducts surprise audits at our site in our offices. So uh, these are very strictly regulated certificates, and this gives us edge over our competitors to supply our products into the premium market like food and beverage and other food industry.
Okay. Next question from Subodh Sharma. What are the principal raw materials used by the company and which raw material has the greatest impact on gross margins?
So at present, we are using sulfur dioxide gas produced by burning sulfur by the various industries. With the expansion of phase two, we will be burning sulfur in our production facility only. So sulfur is the key raw material which has uh, great impact on our gross margins. But overall, we are successfully passing our raw material cost variations or fluctuations to our customers. So there is, if you see last 3 years, our profit and loss statement, there is no big difference in our gross margins. So it's not volatile.
Okay, sir. Next question from Shankar Panchal. How concentrated is the supplier base for liquid SO2, sodium carbonate, sodium hydroxide, and liquid ammonia?
The concentration of the supplier base, how would I describe this? Mm, There are lots of manufacturers in Gujarat only, so we procure these from Gujarat.
Okay. Next question. Okay, from Harsh. What is the capacity utilization for the second 18,000 MT in Batla?
So in Bavla phase one facility where we produce sodium sulfite, it has a installed capacity of 18,000 metric tons per annum. We currently we are utilizing 40% of the total capacity.
Okay. Next question from Apeksha. Does the company use annual supply arrangements, spot purchases, or a mix of both for key raw materials?
A mix of both for key raw materials. We don't do annual supply agreements, but with some of the raw material suppliers, we do quantity supply agreements on an annual basis. So it's mix of both.
Okay. Next question From Sanjay Patil, how sensitive are EBITDA margins to movements in ammonia, sulfur-related inputs, and other major feedstock prices?
Uh, I would say there is no sensitivity in our EBITDA margins because of these major movements in ammonia and sulfur prices. Since we pass our all uh, prices to our customers, we do not have to absorb this price volatility. So the EBITDA margins remain same between 20 to 22%.
Okay. Next question from Harsh. When will the expansion be ready and what will be capacity utilization in financial year 27-28?
So the expansion will be ready by June 2027. We expect commercial production to start by June 2027. And for the first year, FY 28, we expect utilization somewhere between 40-45%.
Okay. Next question from Harsh. Do we expect revenue and profits to triple with increasing capacity?
Yes, but over the years.
Okay, sir. Next question from Harsh. Why is the dilution 33 PCT when minimum required is 26 PCT?
So as I said in our presentation that the entire fundraising will go to our capex. The project cost is 107 crores. So we diluted 33% based on our fund requirement in our project expansion.
Okay. Next question from Harsh. Please highlight on Bodal chemical connection.
So Bodal Chemicals, the promoters of the Bodal Chemicals are our family. The chairman of the company is a real brother of my father. And for the business perspective, we do not have a big relationship with them. We sell our one of our product to them, but that sales is less than 1% of our total sales.
Okay. Next question. Next is from Gokul. All the best for your IPO. Looking forward to the
Thank you.
IPO from Devesh. Best wishes from
Thank
Veer.
you.
So, sir, I think we
Thank you.
have covered majority of the questions. Thank you, Avrish sir. Thank you, Roshan sir. Thank you, Jayesh sir. Thank you, Tushar
Thank
sir.
you, everyone.
Thank you.
Thank you everyone for
I
joining.
think
Thank you so much.
one slide was left out about the
Thank
timing
you.
of the IPO. I would request if Roshan can just
Yeah, about the
highlight that
issue structure,
last
please
slide,
quickly
issue
highlight
structure
that.
part.
Yeah.
Yeah. The last slide, if you can just put it on the screen also.
Okay.
So the one after this. Yes, so our issue will open on the 31st of this month.
Yes.
So 31st, 1st, and 2nd are the days of our issue. Like someone mentioned rightly, we are diluting 33%. The post issue implied market cap at the highest price band is 143.15. Um, our anchor has completed today. You will hear the announcement on our completed anchor today. We the expected listing is on the 7th of September, and our issue is on NSE merge. I look forward to your participation from all of you, and thank you very much for joining the call today.
Thank you, Roshan sir. Thank you, Jayesh sir. Thank you, Tushar sir.
Thank you
And
very
thank you,
much.
Anu. And
Thank
all
you.
Thank
the
you.
best for the IPO, sir.
Thank you. Thank you all for joining.
Thank
Thank
you.
you.
Thank you.